So what we're seeing now, though, as we're coming after Easter, listing numbers have started to slow down, the flow of new listings, but the absorption rate has also slowed down. There's less buyers out there.
You mean clearance?
Well, yeah.
No, is that what you mean by absorption?
Well, clearance we kind of use for auctions, but so the number of listings in the marketplace, they're simply not selling as quickly as they used to be.
Right.
So they're not being absorbed by the market. By demand. I think demand is starting to face some headwinds, right? Just from confidence, from higher interest rates, from serviceability factors. So we're seeing, clearance rates are down. They're holding around the low 50% range now in the two major auction markets of Sydney and Melbourne.
So 50% of the properties on the market for sale for auction are being sold
Under the hammer.
and the other 50%, well, we don't exactly know what happens to those.
Oh, so if you don't sell at auction, well, there's a whole bunch of different ways to sell a property. Obviously, you've got private treaty and auction are the two main ways. So in Sydney and Melbourne, about 40% of homes are taken to market by auction. So there's still that 60% that are sold by private treaty. If your auction fails, either you can withdraw it from the market or you go into a private treaty style listing campaign. Right. So a normal auction clearance rate's about 65, 66%.
In a normal market for us.
Normal market. When the market's really strong, it's up around 80%.
Wow.
So to be around 50% is that's quite unique. You don't see that.
That's a pretty quick reaction.
Pretty quick. Yeah.
Because the warning started at the end of February, beginning of March, 3rd of March, what it was.
Yeah.
Anyway, they ran that territory. We're only midway through April.
But remember, the market was already slowing leading into Iran. So, clearance rates are already starting to come down, and now they've fallen a lot more sharply.
So are you saying, therefore, as well as that, are you also saying that the amount of stock available for sale by whatever way is starting to retreat a bit?
It's picking up.
It's actually picking up?
It's picking up.
More for sale?
Yes.
Wow.
Not due to vendors coming into the market, simply due to stock sitting there for longer.
That it has been there?
Exactly. So
that was already there, committed there, say in February.
That's exactly right.
Right.
So we kind of look at listings in two ways. You look at the flow, so the number of new listings being added to the market, and then the stock.
The stock.
Which is your total inventory level. So the flow is pretty mild. We're not really seeing vendors rushing in to sell. We were pre-Easter. Yeah, exactly. But stock is sitting there longer. So clearance rates are down, time markets up a little bit, vendor discounting rates, which are like how much negotiations in a market starting to pick up. For all those reasons, we're now seeing Sydney and Melbourne listings, total listing numbers are tracking about 5% above average now. Perth, where listings have been tracking like 40% below average, is now more like 30% below average, right? It's still a really tight market, but you can see really clearly the trajectory is upwards for stock levels.
And when you get a trajectory upwards like that for stock levels, in other words, stuff available for sale, what do you guys see in terms of pricing?
It means there's more choice. So there's more supply.
More supply.
And if you're seeing demand falling away, like it seems to be at the moment, then that's where you generally start to see either less upwards pressure on prices or some downwards pressure on prices. That's exactly what we're seeing in Sydney and Melbourne, the two markets where stock levels are now above average. Prices are falling. They're not falling sharply, but the last 3 months, like the March quarter, Sydney and Melbourne were both down about 0.5%.
For the quarter?
For the quarter.
I've seen some predictions with the assumption that with two more rate rises this year, so that's assuming there's another one in May and another one, post May. That one prediction was that Melbourne prices will go down by 6%. Sydney prices will go down by Sydney prices will go down by a lesser amount. It might have been 4 or 5%. Brisbane will stay flat, and Perth is going to still do okay, but not like they have been doing. Adelaide's still okay, not like they have been doing, and Tasmania's been doing it tough for a while, and they didn't really cover off Northern Territory. But what does Cotality see? Given we're talking about assumptions here, of course.
Yeah.
So what are you guys seeing?
Well, let me start by saying forecasting the market's hard, especially now, right? Yeah. There's so many moving parts. Seeing Sydney and Melbourne finish the year in negative territory, I think that's probably logical.
Seeing them finish 2026?
Yeah, exactly.
June or December?
December,
right.
Yeah, so the calendar year.
Negative for the year or negative?
Negative for the calendar year.
For the calendar year, wow.
Yeah, well, prices have been falling through January, February, March, a daily index, if anyone wants to track the market daily. is still falling, and it's gathering some momentum. So yeah, absolutely. I'd be surprised if the market wasn't down by the end of the year.
And when you say the market, do you mean everything, every single category in the market, every single price category, or which sort of band are we talking about? From what to what?
Really important question, right? So at the moment, most of the downwards pressure is coming from your more expensive end of the market, the upper quartile. The middle of the market, generally pretty flat. Your more affordable end, and this is pretty different from previous cycles, it's this more affordable lower quartile of the market. So your most affordable 25% of the market that's really been supporting growth. It seems to be that's where a lot of mainstream demand is now deflecting, simply because that's where people can obtain credit. Remember, we need to demonstrate ability to service a mortgage 3 percentage points higher than the going mortgage rate. So that's getting close to a 9% serviceability mortgage rate. We've got incentives for first home buyers. So the 5% deposit guarantee is probably the best example. And we've got elevated levels of investors. So investors are about 40% of demand at the moment. So all these segments of the market are progressively competing for stock at that lower end of the housing price spectrum.
Where's Cotality say the lower end is? From what price to what price? From zero to, not zero, from let's say $100,000, because you're not going to buy anything less than that in New South Wales, for example, to what is it, to 1.5 million?
Yeah, not quite. So we base it on percentiles. So I'll use Sydney as a good example, right? So the 25th percentile in Sydney is about $1.2 million.
That's the upper end.
No, that's the lower quartile.
The lower
That's the 25th percentile.
Right.
So anything below $1.2 million will be considered in the lower quartile of the market.
Right.
Right, for houses.
Yeah.
You got your median, about 1.6 million. Your upper quartile, so starting at the 75th percentile and above, is around 2.3 million up.
Right. So, and are you saying that's the area that's being most affected in a negative way at the moment? Say in that example for Sydney,
the upper quartile.
Yeah,
absolutely.
Above what was the number?
2.3 million.
Anything above 2.3 million.
Yeah. And it's the same in almost every capital city. It's that upper quartile that's been underperforming, if not falling in value, and the lower quartile is where values are rising the most rapidly or not falling.
And it's not a direct swap, though. I don't think you're saying as well that the people who normally play in the upper quartile all of a sudden looking at the lower quartile.
No. So what I'm saying is
they're unique.
They're very different. So if you think about your uber prestige market, like 15, 20 million plus, that market's quite insulated from things like interest rates and labor markets and that type of thing, right? It's much more influenced by equities or global currency flows, that type of thing. So very different kettle of fish. With your upper quartile, say 2.3 million plus in Sydney, I think that's where we're seeing a mainstream buyer probably is finding it hard to actually get credit at that level, given how high interest rates are and how high household debt levels have risen to be. So progressively, let me take a step back.
So does that person say, I can't afford in that category anymore, I'm going to go to the next category down, or they just don't do anything?
Well, they probably go to the bank or it's Yellow Brick Road or whatever, and they say, here's my income, here's my current debt, how much can I actually borrow?
Yeah, it'll be about 5% less at the moment.
Yeah, so if you're on the median household income in Australia, and you want to buy the median price dwelling, and you're lucky enough to have a 20% deposit, on those assumptions, and you're paying down a principal and interest loan over 30 years, on those assumptions, you'd be dedicating about 45% of your pre-tax household income to service the mortgage. So most lenders aren't going to lend you on those sort of numbers. What it really means is if you're on the median household income, you probably can't afford to buy the median price anymore. Your demand is getting deflected to lower price points.
So do you have data that sort of, can you get access to data that sort of suggests that those people are migrating to the next layer?
Well, no. I mean, it's intuitive though.
Yeah. Right.
So, I mean, we're still seeing demand in the market. Last year, transactional activity was actually well above average. But I think if you want to buy into the marketplace, most people are going to be credit dependent. So if you can't demonstrate an ability to service your mortgage, your credit at a particular price point, probably means you're going to be looking maybe a bit further afield, maybe an apartment rather than a house, maybe regionally rather than in the capital city as well, which are all trends that we're seeing.
But therefore, that in itself, that brings demand into another category, and can one assume therefore that particular category will start to see an increase in prices because there are more buyers going into those lower categories or new categories because they couldn't previously get they can't no longer get funded like they previously could into let's call it the $2.3 million category?
Well, I think that's exactly what we're seeing. That's
what you are seeing.
That's why we're seeing more value growth at the middle to lower end of the marketplace. Yeah. And don't forget, you've also got this amplification of demand at the lower price points by, say, a 5% deposit guarantee for first home buyers.
We're experiencing that at the moment. Yeah, we're getting a lot of activity.
It's pretty clear.
Yeah.
But I think first home buyers, they're eventually going to hit a serviceability wall as well. It's one thing buying a home with a 5% deposit. It's another thing servicing a loan with a 95% LVR, especially as prices continue to rise around those lower price points and interest rates go up.
Except that you mentioned something interesting earlier, but the threshold is so high that the additional threshold over and above the interest rate is so high that they're assessed on, like, let's call it 9%. They probably won't feel, God hope this is the case, but we won't see 3% interest rate rise. Yeah. Given the oil prices and inflation, etc. Hopefully we won't see, that's like, 10 interest rate rises. Hopefully we won't see that many interest rate rises.